gentlemen, Graeme Holm here, aka Australia's original money mentor, and it's an absolute pleasure as always each week to introduce you to the brilliant Dr. Andrew Wilson. I won't cover off his credentials. Most of you by now should know who he is and the amount of weight, his accreditations and his experience. He's definitely well versed as a talking head in the industry, and his knowledge, his degrees, his accreditation cover all of that. So let's not muck around. Well, as I said, ladies and gentlemen, welcome to 2023. Can you believe it? 2023 is here. Hope you're all well rested and a big, very warm, sunny, thankfully, this year already. Big, warm, sunny welcome to Doc. Hello, Doc.
Yeah, good day, Graeme, and hello, everyone out there, and Happy New Year. It's not only the new year, we've almost gone through 1 month of the new year, Graeme. So
would you believe it? We all had a bit of a holiday.
Yeah, but that's what happens, isn't it? You think, oh, my God, where did January go? And it's gone because it just goes vit, and there it is. It's gone, and it's back to work, and it's February, and we're talking property and everything else, of course, associated with that again. But, you know, it's a new year. It will be a new year in terms of the, I guess, the outcomes for our property markets. Of course, it was an absolute roller coaster last year. If we remember, can we remember last year? Eventually, of course, high prices squeeze out buyers because the incomes can't keep up with those looking to get a loan in a hot market. And of course, a lot of what drove housing markets in 21 and into 22, Graeme, was pent-up demand through COVID. You know, a lot of that was then satisfied. Those that had been unable to get into the market through COVID, that pent-up demand was created and then it was satisfied. But of course, so we did see prices starting to ease in the first quarter of 2022. But of course, along came the Reserve Bank, along came inflation. And with the rest of the world, our central banks became quite concerned about what was happening with inflation. And of course, the medicine for inflation is higher interest rates, quell demand, stop people spending. How do you do that? Put up interest rates. That's what the textbooks tell us. And of course, the Reserve Bank was probably a little slow to act, Graeme. Perhaps an argument for that. I think you've mentioned that. And but they did act, and when they acted, they certainly acted with a vengeance. And that we had the first interest rate increase for over 10 years in May, and we've had an interest rate increase every single month since May, Graeme. And of course, firstly,
Mayday, it hasn't stopped.
Yes. Mayday, yes. And it was a bit of a mayday, but because not only do higher interest rates impact the housing markets because you have to pay more for your mortgage, therefore you can't afford to pay as much in the market, and that again sidelines buyers because they can't keep up with higher mortgage rates. But also importantly, the first rise in over 10 years certainly impacts confidence. It was fertile ground for all the doomsayers out there, Graeme. You know, rates are rising. It's the end of the world. House prices are going to crash 10, 20, 30%, pick your number, but it's going to be a disaster. We've had all those headlines, all those predictions as a result of those increase in interest rates. But, you know, Graeme, considering we've had an interest rate increase every month through to December in 2022 from May, and it was the first increase, as I said, in over 10 years, I think our markets have stood up remarkably well. And it's been a very modest decline phase for our housing markets last year. And really, it was all about the winter market, which is typically a quieter market anyway. And we started to see a spring revival. Can you believe it? Not a collapse in the housing market. Buyers came back into the market. Sellers came back into the market. And in fact, we had quite a reasonable spring selling season, which was remarkable.
Hang on, Doc. We've heard what I like to call verbal diarrhea, which is the doomsday preppers. The sky is falling, Chicken Little, right? 30%, 20%. Like you said, pick a number.
Yeah.
So what I'm hearing, and I know this from last year, you gave me some data last year. Before the year wrapped up, you said, Graeme, one of our last podcasts on YouTube, probably about 3.7, I think.
Yes.
You said late 3%.
Yes,
national house price average. Still don't know what a national house looks like on average, but when you look at all the ups and downs of each state and territory, averaged out across that. So How far off the mark were we at the end of the year to the last few weeks of data?
Well, I've done a little bit of a narrative there, Graeme, on last year. Okay. So we can look at the numbers now for 2022. We had a quick look at the preliminary numbers at the end of last year. We've obviously got some more data through since then. There hasn't been much of a change in the numbers, and that was the point of last year's podcast at the end of the year. These were the preliminary numbers. Now we have a much more settled measure of 2022. So let's have a look at it. What did happen in 2022 on the numbers, Graeme?
It had to be negative 20, 30, 40%.
Well, we'll have a look, mate. And here it is. So let's look at those annual home prices. So what are we measuring here, Graeme? Well, what we're measuring here is quarterly house price numbers or data. So that's the number of sales. These are house and unit sales, homes, conducted over a 3-month period. Now, the reason we use 3 months is because you need as many sales observations as you can get to get a reliable number.
Sure.
The smaller the smaller the time frame for your data set, the more volatile numbers are, because every house, price is, because every house is different in time and space.
Sure.
And prices are different because buyers and sellers have different agendas and different capabilities. Yep. So we need to have a reasonably robust period of time to measure house prices so we can get a feel for what that underlying change or what that underlying noise is, up or down, in our housing market. So what we measure here at My Housing Market, and it's the same with the most of the other data providers, is quarterly house price numbers. And, of course, the ABS that no longer produce an index series as they had for many years. That was the same methodology that they used, quarterly data sets. And My Housing Market, it uses exactly the same methodology as the ABS used for decades. So let's have a look at the annual home price outcomes now.
So we're getting 4 snapshots a year, Doc. We're getting quarterly data, not a weekly, not a day. So we're getting a quarterly period of a snapshot, and then we're getting that each quarter throughout the year to then tell us how we performed.
And what My Housing Market is doing, Graeme, and this is hot off the press, is we will be actually doing quarterly house price models on a daily basis.
On a daily basis,
Graeme. Hang on to your hat here.
Watch this space.
So what that means is that we'll be taking 90-day snapshots. That's 3 months, quarter, 13 weeks, over from day to day to day to day. So that'll give you, for example, today we can get a median house price based on the sales in that area, capital city area, for the last 90 days. So that gives us a daily version of what's happening in the housing market. And it gives us the robust numbers, 3 months, but it gives it to us every single day. Now, for today, what we're going to look at is the 2022 annual change in home prices, units and houses. So what we're going to be measuring is the 3 months to the end of December 21 versus the 3 months to the end of 2022. So it's the last 3 months of 2021 versus the last 3 months of 2022.
The last quarter versus last quarter.
Yeah, so that gives us what's happened on the yearly basis at the end of the year. So we can call that
same season. So winter, summer. Right. So using the last quarter, the last quarter.
Yeah, so we don't have any real seasonality issues, even though there was some change in seasonality in relation to COVID. Mm-hmm. So we're measuring like with like, and it's year to year, and it's the current year, the full year. Now, the other point you mentioned, Graeme, which is a good point, was where is the national house price? Well, what is the national house price? Where is the national house?
Big,
well, I don't
small,
know.
Square, round, flat.
Yeah, but what these national prices measure is a weighted average of all the capital cities. So what we do is we look at the number of properties in each of the capital cities And then we create a weighted average based on the proportion of properties that are in each of those capital cities. Now, what this means, of course, Graeme, is because you're using a weighted average, that the big capital cities contribute more to the national house price because they got more properties, right? And that makes sense because...
Just for clarity, Doc, say that again.
Well, that's the point is that Melbourne, Sydney and Brisbane, but particularly Melbourne and Sydney, obviously have a lot more houses than Adelaide, Perth and Canberra, Hobart and Darwin. So they make up a much bigger proportion of that weighted average because it's based on the number of houses. So, really, when we look at the national house price, it's more about Sydney and Melbourne than it is about the smaller capitals. So we're really talking Sydney and Melbourne. So if Sydney and Melbourne have tough years, that means the national house price has a tough year, right? Yep. If they have a good year, well, the national house price, it has a good year too.
And just to give some logic to that, Doc, let's say I live in Brisbane, right?
Yep.
If Sydney booms, but Brisbane has a shitter, and you look, the national house price went up 20% because Sydney went up 30 or 40, but Brisbane's down. And you hang on, no, my house didn't go up in Brisbane. So we're trying to, I guess where Doc and I are going with this, ladies and gentlemen listening along at home, we're trying to give you some context to what we usually talk about, because there was a lot of people reaching out. I was going, I seen this headline and I seen that, and no one really understand it. So Doc's just giving you some clarity today to start the year. Where is the data coming from?
And look, Graeme, and these are all sales, and they're validated sales, agent reported sales from a number of sources. So, and the numbers, as you'll see, are similar, if not exactly the same, similar to other data models that are out there. And the thing about My Housing Market is that we bring our models out sooner than any of the other data models. So, but we've got to understand that the national house price is really the Sydney and Melbourne house price. You know what I mean? So if we're talking about and you hit the nail on the head there, mate. If we're talking about the national house price has fallen or whatever, we're really talking about Sydney and Melbourne. So, but a lot of the headlines, of course, are reflecting Sydney and Melbourne. So therefore, obviously, if Sydney and Melbourne have fallen away, you're getting the headline, house prices are falling, it's a crash.
Yep.
And that impacts because, the national media will report that. And that will impact home buyers and sellers' view of the market in the states which aren't Sydney and Melbourne, or the capital cities like Brisbane, Adelaide and Perth. And they'll be thinking, this isn't good. So it can have that effect up and down. But at the end of the day, we're really talking about the impact of Melbourne and Sydney on the national house price. And, this is what the media talks about, the national house price. So let's have a look at the results for last year, Graeme.
Okay, quarter v quarter. Last quarter, 21 v 22.
That's right. And the national house price is a conglomerate of a weighted average for all the capital cities based on the number of houses and units in each of those capital cities. So this is the results, Graeme. These are the latest results. And you can see there, it's Melbourne and Sydney, mate. Sydney was the worst performer, down 9.1, not 10%, Graeme, 9.1. It was going to be 10, 20, 30.
Yeah. Down
9.1. Melbourne came in as the second worst performer at 6.1%. Guess what happened with everywhere else? Everywhere else it grew. Brisbane, Adelaide and Perth all had positive house price.
Doc. The national house price is down. You can't have made money anywhere if you owned a home in Australia last year.
Up. But the point is that 9.1% Sydney down and 6.1% Melbourne down mean that the national price fell by 4.3%. So,
and Doc, we're coming off the back of Sydney the year prior, or the 2 years prior, say 3 years prior. You're coming off the back of what, 30-odd% in growth across.
Well, look at that in a minute, mate.
Oh, well, I don't want to steal your thunder.
You're teasing here, mate. But isn't it interesting that the Perth housing market was the best performer last year, up by 6.9%. Now, Perth's been dragging the chain for a long time, Graeme, as we know, in fact, for a decade. And that's because of the impact of the end of the, two previous mining booms on the Perth housing market. Starting to pick up now. I don't think it's going to get back to where it was prior to the mining booms, but it's certainly on the move. And it is the most affordable market in the country. So, it makes sense, affordability in Perth, and it has a very strong economy, of course. The Western Australian economy is one of the strongest in the world. But nonetheless, the Perth was the leader. But as I said, national house price down 4.3%. But it was only Melbourne and Sydney, mate, that contributed to that. So let's go forward now. And I think it's interesting also, Graeme, before we look at what's happened over the past couple of years, let's have a look at units, how units performed last year.
Well, this is a good one, Doc, because I constantly hear never buy a unit. They don't make any money. Mate,
look at these numbers. Seriously. So they're similar to what we saw with houses, but they're not. They're better. They're better, except for Perth. Now, as we remember, Perth was up 6.9 for houses over the year, but it was only up 2.3% for units, right? Similar numbers in Sydney and Melbourne. Melbourne underperformed versus Sydney, whereas the reverse was that Sydney underperformed versus Melbourne for houses. But look at Brisbane and Adelaide, mate. Look at the results for Brisbane and Adelaide. Double-figure results for unit price growth in Brisbane and Adelaide, 11%.
And this is critically important, Doc, for people listening in that listen to us each week. Well, we're not on holidays, obviously, but listen each week, and they do get confused in messages from the headline going, "Oh, I've lost money on my home or my investment." But hang on, was it a unit? Was it a house? Was it round? Was it oblong? Was it what color? It's really critical that they get the context like you're providing here today in the data, because if they had an apartment in Brisbane that's meant to be the poor cousin to Sydney and Melbourne,
11%.
They're up 11. Plus their rental yield would have been really strong in Queensland.
And this is big. Look, we know what's driven Brisbane has been the surge in migration, but the unit market's also been driven by affordability. And Graeme, I believe going forward, of course, the units will continue to be a target for buyers because of that affordability advantage, because of their location advantages.
Yield.
Yeah, that's right. In a high interest rate environment. So again, with units, it's the same story, mate. Sydney and Melbourne down, national house price down 4.2. But look at everywhere else. Look at Adelaide and Brisbane, double figure increases in unit prices.
And go figure, there's still plenty of land in Adelaide, yet the units are booming.
Well, it's a very small market, the Adelaide market, Graeme, and that's what makes it a good prospect, because there's not a lot of choice if you're looking for a unit, particularly inner city units in Adelaide. That's starting to develop. That inner city unit market in Adelaide is developing. We know Adelaide's very much a low-rise environment, but units are certainly taking off there and coming from a very affordable base, and I think that's part of what's growing the units. But in Brisbane, there's now a shortage. Can you believe? Do you remember those years of headlines about oversupply? Flooded Brisbane market, flooded with units. It'll never recover. My God, they're now the state government and the local Brisbane government are screaming to get more units developed, but they can't find the land. Developers are queuing up to try to get proposals off the ground.
Even if you found the land, good luck finding somebody to build it and trade supplies and materials, because maybe talk on construction costs next week again. But
yes, we will. Again, the data is validating, what we say about how misleading those headlines regarding the national house price can be. Because they don't tell you what's happening in local markets, because they are skewed towards Sydney and Melbourne. So let's have a look at 2022, which we've looked at there, Graeme, versus 2021 prices, okay? So this is, as you said, I should have put this up as a slide going forward to show us 2022 versus 2021. But you can see there, obviously, there's a big difference from 2021 to 2022. 2021, we mentioned, was a booming market, and 2022 was a market that was adjusting downwards following a very strong period. And you can see there, Graeme, that it's a big difference between what happened in 2021 generally and what happened in 2022. So let's do the math so we won't have people out there doing mental arithmetic, which can be a challenge. So we'll do it for you, folks. And here it is. This is the difference in the 2-year period. This is how house prices, even with the declines last year in 2022, in Melbourne's up 16.9. And just a little hint to the future, I think that the fact that Melbourne has underperformed, even though that's a pretty good result, Graeme, over 2 years.
No, but I know what you're going to say, Doc, and that's all right because I'm about to sign a couple more contracts in Melbourne. You're going to tell me, even though it's underperformed a bit and it got hammered pretty hard, do you think there's a bit of room to run in Melbourne? I can feel it.
Yeah, absolutely. And
there's a recovery coming.
We'll talk about that shortly, Graeme, when we look at my forecasts for this year. But when we look at the others, Sydney up 23.8% over the past 2 years, Perth up 23.4%, Adelaide 31.5%, and holy moly, look at that Brisbane market, mate, 34.6% in 2 years. That's 15% each year, Graeme. Yeah. And so, that's the real number here. And again, where's the doomsaying? I mean, you can talk peak to trough, you can talk quarter to quarter, but over the past 2 years, that's December quarter 2021 to December quarter 2020 to December quarter 2022, we've had this remarkable growth in Australian capital cities.
We better not compare that to the stock market in the same period because it might look...
Well, Graeme, the stock market, sadly, isn't that much ahead of where it was in 2007.
Yeah.
So how old were you in 2007, mate?
Jeez, how long ago was that? Bloody
That's
hell.
a long time ago. That's like 16 years ago.
I was in my young 20s then, Doc. Jeez.
Well, mate, it's a long time, and that tells you the growth in the stock market since its peak back in 2007. It's roundabout still at those numbers, and that's pretty ordinary, but especially considering that, major international stock markets have doubled in that period. The US has doubled in that period, nearly doubled in that period. So these numbers are rational. There, you'll see them on all the other data sets that are produced, Graeme, and this does give you that, real understanding of our housing markets.
So nobody's buying a home, Doc, and looking to buy today and selling in exactly 12 months. It's a long-term play or medium.
That's why it's called a home, mate. It's a home. It's something you live in. You grow your family in. And you retire into, whatever, right?
It's your Bonnie Doon. How's the serenity? It goes to the pool room. You might have a bit of lawn porn going on. You got the greenest lawn in the block. And if it's an investment, Doc, you don't buy it today to sell it tomorrow. Oh, no, I bought it in Sydney this year and had a bad year. Yeah. It's a long-term play.
Yeah, we're not talking crypto here, mate.
What's that?
It's a non-fungible asset, isn't that, or something?
I
don't know. It's above me. Yeah. But so we'll have a look at the in fact, before we do that, Graeme, what I might do is I want to discuss, you mentioned before about the historical the historical nature of Australian house prices.
Yes.
So if we go back and use ABS data, we've only had 4 declines in house prices, annual declines. That's measuring December quarter to December quarter, right? Same methodology, all exactly the same. We've only had 4 years where prices since 1987, if you think 2000, well, that's another 20 years further back from 2007, mate. Mm-hmm. So were you born then? But anyway.
I'm an 83. It's a good drop, 83. It's not too bad. So
since 87, we've had 4 years of declines in house price. 4 years we've had. 2008, 2011, 2018, and of course, 2022. Now, the worst we've had, and of course, last year, 2022, was the first annual decline in house prices we've had since 2018, right? And in 2018, annual house prices decreased by 5.5%. Now, we're down 4.3. percent in 2022. So it's still well below, certainly below the worst result, which was 2018. And people, when they say, is that the worst result we've had? Well, yes, it is the worst result we've had. And it's the first decline in over a year that we've had in 4 years. And we've seen the results just over the last 2 years, the net results of growth, which are still in front of us there, Graeme, and they're quite spectacular. Now, if we look at the median house prices as they were over the December quarter, we can see Sydney still out there in the lead, ahead of Melbourne, Brisbane, Adelaide and Perth. It's interesting, the difference between Brisbane and Melbourne and Adelaide has sort of become closer because of how strong a run that Brisbane market has had. And we've discussed, of course, a lot of that was driven by migrants coming out of COVID-hit capitals such as Melbourne and Sydney, which have really pushed up house prices and unit prices in Brisbane, and that gap is narrowing. It's still a bit of a gap, but we can see the median unit prices in Brisbane are now over 400,000, Graeme, and that's been, as we saw before, quite a substantial leap over the past year. So, if we look at the summary to all of that, only Sydney and Melbourne reported home price falls over 2022. Sydney house prices.
Only Sydney and Melbourne.
Only Sydney and Melbourne, mate.
Okay.
Of the major capitals, right? Reported house price falls over 2022. Despite those falls, Sydney's still 23.8% higher over the past 2 years, and Melbourne's up 16.9%. Units outperformed houses for prices growth over the year. National house prices fell 4.3% over 2022, which was the first decline since 2018, when prices were down 5.5%. So predictions of house price falls of 10% plus, national house price falls of 10% plus, which we discussed over and over again, Graeme, through 2022, were well off the mark with 5.5%. And I believe that, as we've seen following other periods of calendar year annual price declines, that we will record positive growth this year.
I agree.
This year, 2023.
Well, Doc, you've just hit the nail on the head. We have never had 2 consecutive years of national house price average declines.
That's right.
Following every decline, there's actually been a very healthy increase.
Yeah, and these things all depend on the circumstances of the market, Graeme. And the things that's important this year to understand is that we aren't going to get, almost as a certainty, the sort of rate rises that we've had from May through to December in 2022. Rates have gone through the roof. Now, we're not going to have that happen in 2023. We don't have the same inflationary environment, particularly in regard to the price of oil. There is some sign that our economy is starting to become more balanced between supply and demand. So that gives less impetus for the Reserve Bank. But heads up, Graeme, next week we're going to discuss what's going to happen with interest rates, particularly for the February decision, which is coming up in a couple of weeks, the first decision for the year. We'll discuss what we believe will happen there in our next podcast. And stay tuned. That could be a very interesting result to start the year for the Reserve Bank. So we won't have, in my opinion, anywhere near the rate rises we've had last year. So that's a positive for homeowners, because we are in the middle of a booming economy at the moment. Wages are rising, so less worry over interest rate increases. And of course, on the demand side, significant migration increases this year. We're already starting to see that impact to some degree in terms of the labour market. Now, we're going to look at next week, Graeme, we're going to look at all the latest economic data that has come through when we do discuss what's happening with interest rates, what we believe will happen with interest rates this year. But before we do that, I'm going to fearlessly put forward.
Oh, look out. Don't do that, Doc. It should be negative. Whoa.
There we go, mate. They're my fearless predictions for 2023 in terms of our housing market, right? our capital city. So I believe Perth and Melbourne will be the top performers this year. These are mid-range forecasts. So this is where I believe the middle range will be. It could be a little lower. It could be a little higher. Yeah. And we will discuss the drivers of that next week. Obviously, interest rates will not have the same impact. Strong migration, a booming economy, and some pent-up demand being released from last year, which will add to also local demand. So I believe Melbourne and Perth are looking at around about 7% this year. That's a similar result that Perth had last year, but certainly a better result in Melbourne. I think Melbourne is primed, good value market there. Still some pent-up demand to be released. And, of course, Melbourne will always be a key destination for migration, a big migrant centre. And before we had COVID, of course, the Melbourne market was being driven by record numbers of migrants. And I think that'll sort of return and drive that Melbourne market up 7%. I think Brisbane, Sydney and Adelaide will be quite steady at around about a very positive 5%. I think Sydney's still probably got a little bit of work to do in the prestige market, and that'll hold it back. But I do think the Brisbane and Adelaide markets are primed for another good result in 2023, similar to 2022, particularly the budget end of the market, Graeme. I think that, first home buyers, investors and migrants will be looking at that end of the market, which will continue to produce demand. Canberra, Hobart and Darwin, not as exposed to migration, but still nonetheless, I think that they will record reasonable growth this year as well. So everybody, I think, in the black in 2023. I don't think I'm going to be very far away from this, Graeme, when we do our wrap.
Well, I haven't seen you too far off for the last 3 or 4 years, Doc.
No, well, that's, it's about science, mate. You've got to apply science and not the logic of clickbait to your predictions. But on the other side, isn't it interesting there? My predictions actually show higher growth overall for units this year compared to houses. And see, we've got to understand we're still underbuilding. We'll look at that next week. Building costs have eased a little bit, but they're still very high, Graeme. So that's keeping the numbers of new dwellings coming into the market at lower levels, particularly units. We've got to drive towards more inner suburban, more affordable unit living, and people are starting to look at units as a preferred lifestyle choice, not just a cheaper lifestyle choice, but a better lifestyle choice for many people now. So I think that we're going to see units marginally, but still outperform houses this year, Graeme. Adelaide, Brisbane and Hobart are the top performers, I believe, for units this year will be. Perth, Melbourne and Sydney, just under there at 6%, Canberra and Darwin 4%. I think the Canberra market might be underestimating the Canberra market's upward potential. Okay. I think that might be closer to a 6 than a 4, but we'll see. Okay. I don't tend to be, too emotional here, but it's rational. But still, they're all reasonably good results in recovering markets. So they're my forecasts, Graeme, for my fearless forecast for 2023. We'll see what happens. But again, as you've said, it'll be just another recovery year following a downturn. Right?
Absolutely.
And the drivers are very strong for growth. And confidence is starting to return to the market. And next week, we will also look at the latest house price data, Graeme, for January. So we'll be able to see how markets, even though it will be the January quarter, Graeme, so it will include November and December, but we will look at how it's gone over the year and compare it, how those rolling quarters are going, to give us a sense of how the year has started off. So look forward to that. Just to finish off, Graeme, and I thought we'd do just a quick run through of the latest economic data. There's been a lot of economic data coming through, but I thought it was important to emphasize part of the drive for a recovery year. And really, we're talking about a recovery year in Melbourne and Sydney, aren't we? Because
that's right.
The others don't have to recover because they're
growing.
They're growing, so they'll keep growing. But the jobless rate, the latest jobless rate that we had out last week, Graeme, and this is for December, another record low result. There's been some adjustments from the ABS to their seasonal adjustment model. It's now 3.5%, that which is the all-time record low. So we had another all-time record low result. So it was steady over December. It was interesting that, and we know that all states are lower over the year. The gap's starting to get closer between last year or the year before and the current monthly number.
Isn't that interesting, Doc? You got there, so black is 21, orange is 22. Queensland, where we had a mass record exodus, entry, not exodus from other states, of net interstate migration, yet it's actually decreased its jobless. It is its economies have supported mass inter-migration.
Yes, mate. And a lot of that is because migration can actually create jobs itself.
Yep.
A lot of it, you have the sort of skills coming into the state that can be utilised, right? And of course, the property industry benefits from that because people are coming in buying property. People are selling property to take advantage of all that demand and those higher prices. And so it becomes a little bit of a self-fulfilling environment. And that's a good pickup, Graeme, because you're absolutely right. That's a marvellous result.
Typically, you get a state or territory area flooded with sometimes it can suffer, and there can be a short-term overpopulation and everyone competing for work. Yet the jobless has dropped substantially.
That's right. So there were some interesting points from the unemployment data, Graeme. The December data was steady at 3.5%, which is still the lowest monthly record result on record. But we actually saw the number of jobs. I think we're starting to see the impact of migration on our labour market, and this is a good thing. We actually saw jobs down by 14,600 over the month, and that was the first fall since July. But it really did come from a fall in part-time workers, and that's what we do start to see when because the part-time workers are the first ones sort of put off, right? But also, we've got to understand that November was a very strong month when we look at retail sales data because of Black Friday. Because Black Friday was very big in November, Graeme, for retail. Yep. And I think in December, a lot of those that were put on for Black Friday, lost their jobs. And it just shows you how Black Friday is sort of taking over from Christmas shopping to some degree. The unemployed numbers was up by 6,000. The participation rate was also lower, still high, but it dropped a couple of points to 66.6. But all states, as we saw there, are at record low level unemployment rates. But maybe there's some early signs of that rate-induced and migration-impacted labour market starting to show. And we should expect this, Graeme. They've whacked up rates. We've got hundreds of thousands of migrants coming in. They've got to find jobs. So this is the first, I guess, small sign, might bounce back next month. This is still very good numbers, don't get me wrong. This is still an amazing economy. But the first sign that it's starting to balance out, which is good news, Graeme, because, this is what the Reserve Bank wants. And again, as we'll discuss next week, a bit of a tick for, maybe putting rates, not raising rates again, or certainly not at the rate they were raised last year. And again, as I mentioned, retail sales bounced back. They fell over October retail sales, which was the first fall for a year, but they bounced back very strongly over November. And I think that's a bit of that, as I said, Black Friday energy that pushed up retail sales and actually impacted those part-time jobs falling over December. So people are still spending more, like
drunken sailors.
Mate. They're out there buying. That was November for you, right? So we'll wait for the December results, which will be out shortly, just to see how that develops. But this is still, Graeme, what this is showing us that consumers are still confident. They're out there.
Absolutely.
And I think this, again, is another portent for a positive year, 2023, in the housing market. We had building approvals. Well, we'll talk about building approvals later, Graeme, next week.
Yeah, we'll get into construction costs and approvals next week. And
we'll do that next week. But I think that just finishing off, Graeme, that it's interesting, of course, that the forecasters are coming out now, and we're actually seeing some forecasts of a boom this year. Have you seen that going around?
Yeah,
Mate.
we might do a session, I think, Doc, maybe once a month, where you and I won't run off a PowerPoint. I think we'll actually, you know what we might start doing, Doc? Pulling some articles, blanking out the names or the brand of the media. We might just start doing some commentary of some media.
We could get into trouble there, mate.
Actually, we better not.
My friends in the media, I'm of which I have the greatest respect, and their job is to get attention.
Their job is to get attention. It's a tough job.
It's a tough job, and it's up to those that produce those forecasts and the clickbait commentary to justify it when they get it wrong. But it's interesting, isn't it, that those that support all those negative Nellies, they tend to just ignore the fact that they're wrong year after year, decade after decade.
Well, right? I will say, Doc, you've been pretty right for all of the years I've known you. So, ladies and gentlemen, you've got absolute context today from Doc. We have really broken down how to interpret the data and where the data is coming from. So I really hope today's given you some context. There's a lot more we're kicking off into the new year, so stay tuned for next week as well. Yep. As always, Doc, a big, massive thank you to you, and a big thank you for being real and being accurate and right most of the time. It's important.
Well, it's what I do, so that's great. Graeme, thank you for that. And it'll be really exciting next week to talk about where interest rates are going, won't it?
Absolutely. Look forward to it.
Good on you, mate. Doc. See you later.
Bye. So if you need help or you need to find out more, go to money-mentor.com.au and use the discount code podcast1500. So instead of $19.97 for a weekend full of experts, economists, financial planners, accountants, asset finance, you name it, then go to money-mentor.com.au, use the discount code podcast1500 and it'll drop it from $19.97 to just $4.97. That's $19.97 to just $4.97.